Thank you everyone for joining us today for our seminar on investing in real estate in the San Francisco Bay Area. Before we begin, I'll do a very, very quick real estate market update, and I do want to get to the heart of today's topic. Just a quick look at median sale price since 2006. This is for single family homes in San Mateo County. As you can see, there's this big red line in the middle of the screen, which is vertical line, which is our COVID lockdown. The very dip it goes back to 2008, which is around when I started, real estate. And since then, it's been up and down, but steadily increasing over time. And you do see that over the past couple of years. So when the lockdown first happened, things were stalling a little bit. People didn't know where things would go. And then over the last 2 years, even from end of 2020, the prices just shot up to where we hit an all-time high for the median sale price at 2.25 million. And that was in April of last year. So just to keep in mind that when we say median sale price, that means when you take the homes that are, when you take a price, the same number of homes are selling above that price as below it. So 2.25 million was a little bit crazy. I was saying it's crazy when we hit 1.5 million. In January, toward the end of last year, we did start seeing things coming down a bit. And in January of this year, this median sale price was at 1.48, which is significantly lower than that high of last April. But if you think about it, if you go down to January 2019, that was the median sale price 1.3, and for 2020 is 1.4, and 2021 was 1.5. So being at 1.48 for this January is, I would say, many people are thinking of it as more. We've had a little bit of a correction from the peaks and the little bit of a craze after COVID. Also, months of inventory. You'll hear about inventory levels. So basically what we do is take the number of homes that are on the market, and then how long would it take at the current rate that they're selling, how long would it take for us to run out? And that comes down to what's known as the months of inventory. 6 months right here, the green is considered a balanced market where you have, it's balanced between everybody. If you go above that, so if you have a lot of inventory, that's what's been traditionally known as a buyer's market. And below that is the seller's market. So as you can tell, since about 2012, we've been solidly in a seller's market where our months of inventory have been bouncing around 2 months. And, toward the last couple of years, we were actually in the 1 month territory quite a bit, and sometimes dipping even below 1 month of inventory. As of January, we're at around 2 months of inventory. So people who ask, well, is it a buyer's market? Not totally, right? Not if you look at the inventory levels. Is it a seller's market? Well, if you look at the prices, it's not completely a seller's market in that it's not the craze and the excitement that you would have had in the last couple of years. But I think, again, going back to inventory, that's going to be a big factor. The other I word that we always talk about is the interest rates, which is also a factor, and probably one of the biggest factors in terms of buyers feeling a little bit squeezed as the interest rates almost doubled over the past year. So the demand went down a little bit, and so that's why, or significantly, and so that's why we've seen probably the drop. So that's a simple, quick market update. I did want to hand it over from here to Elsie and Eric, or Eric and Elsie of Abundance 99. I love their company name and was drawn to it because Perisson stands for abundance, and so I think it's really cool. And I've really grown to know Elsie and Eric over the past year or two. I don't know how long it's been, but I love their philosophy as well, because both of them have been great in terms of just trying to find solutions for clients and really being able to get them to the next step.
Well, thank you, Jean, for having Eric and me on this call, and thank you everyone for joining us. So let me do a very quick introduction first, and then we will go through our agenda and then the rest of the presentation. So Eric and I, we have this company, Abundance 99 Inc. We're a mortgage broker. We do residential and commercial loans, and we also do hard money loans. So we help people who cannot get conventional financing from banks to get loans through private investors. And then we help private investors put their money to work in these loans. So why are we talking about real estate, and why did Jean feel that we're qualified enough to tell you about real estate investing? So Eric and we started investing in real estate actively about 19 years ago. At that time, Eric and I were both working in tech. I worked for NCR, TIW, and Hewlett Packard, and Eric worked for NCR, Yahoo, and a couple of startups. So between the two of us, we were thinking that he would do the startup game and I would try to hold a steady job, and that, eventually we would strike gold with the startups and then retire. And then in 2003, 2004, we started seeing a lot of layoffs in Hewlett Packard. And at that time, one of my colleagues from Hewlett Packard was concerned about how dedicated I was to this big corporate. And so I had told her she was my finance person. I had told her over dinner that, hey, I plan to work for Hewlett Packard until I'm 70 years old. And she was really worried about me. So she introduced me to this notion of passive income using real estate, and actually beyond real estate. But she taught me about cash flow investing. And from there, we realized that someone in the family had to step out and create a new income source that's not totally in tech. And that's when we started our journey about 19 years ago. Through that time, we've invested in about, I would say probably around 100 residential rental units. We've owned or co-owned a Walgreens anchor strip center, a medical office building. And then we've also led a few development projects. All in all, we invested in about, I think, in 8 or 9 different states throughout the US. So we were really chasing real estate, chasing cash flow. And we learned a lot of very expensive lessons over the last 19 years. And at this time, we feel that we're, in this cycle, we feel that we're very secure in what we're doing, financially speaking, and we want to pay it forward and help other families develop a strategy so that they can also enjoy passive income through real estate. So here's the high-level agenda, what we're going to be talking about. Big picture, why do people invest in real estate? And why do we feel that we should actually be investing in the San Francisco Bay Area instead of out of state, which is what we concentrated our investments 19 years ago. And then we want to answer a very frequently asked question, which is what to buy in the Bay Area, and give you our high-level recommendations if you are interested in doing more real estate. So why real estate investing? And here I actually want to talk about some of the pros and cons and also the myths. So when we first started investing in real estate, it was because of passive income. We thought that real estate would be, we would be collecting rent while we sleep, and we don't have to worry about the tenants, and everything would be easy. So that's why we started investing in real estate. And honestly, when we started, we were not counting on the appreciation. We were not counting on some of the major increases that we have seen in value in the last few years. But because of what we learned in terms of the importance of cash flow, we focused on cash flow. And at the end of the day, what we have learned is that our cash flow pales in comparison with what we actually made in appreciation. And that's part of the big picture that we wanted to people to think about as they look at investing in real estate. So investing in real estate pros, well, in the Bay Area especially, there's very limited supply. And as Jean showed earlier, there's only 2 months of inventory, probably even less right now, and they're just not building new homes. And there's no place Bay Area, we're so landlocked. There's no more places to build, or not in a big way. So that's a big positive. And then, of course, it's income producing, it's a good inflation hedge. And there are a lot of special tax treatments. And something that a lot of people don't recognize when they talk about real estate investing and cash flow is that when you invest in real estate in California, your costs are mostly fixed. So yes, you have property tax, but in California, at least right now, your property tax increase is pretty limited because of Prop 13. And that's also true for commercial properties, but that may change. So because you have fixed cost and your income will continue to go up with the inflation, then your cash flow will continue to increase, and your appreciation on real estate will help you in terms of growing your overall wealth. So then, what are the negatives in real estate? And we hear this a lot, but there's also some myths to some of these as well. So yes, big upfront investment. Not everybody can do a 20%, 30%, 40% down payment to break even on a rental property in California. That is a big issue, but there are ways of working around it. Functional obsolescence of properties. So, if you buy a property that is 40 years old, and for example, it's only a 2-bedroom, 1-bath, and most couples now want 2 bedrooms and 2.5 baths, or sorry, 2 bedrooms and 2 baths, then the lack of that 1 bathroom may make yours less appealing. But I think that's true for anything. In tech companies, there's creative destruction, right? So Apple has to constantly reinvent itself. It has to invest a lot of money to reinvest in the company. And that's true in real estate also. So other cons you have in real estate investing, debt burden. You have a mortgage, you have to pay the mortgage. And if you don't have the holding power, the mortgage can eat you alive. You need to think about that when you invest. But then that's also true for tech companies that you may invest in. They also have debt burden. And when you invest in stocks, do you look at the company's debt burden the same way you look at your own debt burden on mortgages? And then, of course, people complain or worry about tenant issues. Yes, I think there are definitely concerns if you have a bad tenant, but there are things that you can do to learn to manage tenants and to make sure that you only rent to good tenants and you don't inherit bad tenants from previous owners' poor management. So these are things that we can discuss also. And then people also talk about rent control as an example of regulatory changes. That is a big negative for real estate investing. That's also true, but there are also ways of working with the regulation and still provide good housing and good income for your family. So then what are the myths for real estate investing? Myth number 1, people talk about investing for cash flow. And that's it's important to invest in cash flow. So I agree. When we initially invested in real estate, we were all about cash flow. At that time, Eric and I, we drove up and down California. We went to a few other states chasing cash flow. And what we realized is that the cash flow in some of these out-of-state locations are good, but one little issue, one turnover, one air conditioning breaking down, one hail damage, then your cash flow for the year is gone. So it became, and for some of our properties, it became a forced savings plan. That every year, yes, you have to pay the mortgage. Tenant contribute to your mortgage, but you're paying mortgage. And then so you're getting their mortgage, getting their rent to pay your mortgage, but it's a forced savings plan without a lot to show for. There was one property that Eric and I bought in New Mexico, single family home, great cash flow, no worries at all. And then after 10 years, I think we made a total of $2,000. So that's not a lot of money. So it became a forced savings plan. And then the second myth So back to cash flow. So I don't think that in evaluating your real estate investment strategy, I don't think it's wise to just focus on cash flow. I think it's important to look at cash flow and appreciation and long-term outlook for the property so that you know exactly what you're getting into. And then the second myth that people often talk about is passive income, that rental properties are passive. But the reality is rental properties are not passive. I think if you hire a property manager, you still need to tell the property manager when you want, before you buy, you have to decide where you're going to buy. You have to decide what type of property you're going to buy. And once you hire a property manager, if you hire a property manager, you need to manage them. You need to make sure that they are choosing the right tenants. You need to make sure that they're upgrading the property for you so that it continues to attract the best tenants available on the market for your property and have the highest rent. You need to decide how frequently to raise rent. So you can't just leave it to your property manager and expect great results. Not to say that they don't care, but the property managers often have to handle 500 to 1,000 units, and you are just one of many, many clients that they have to serve. So all of these are big things to consider when it comes to real estate investing and the things that you need to think about as you formulate your strategy and decide how you want to play in this market. Yeah, this is so true. I think the tenants, I think there are always good tenants and there are always bad tenants in every single market. And there are ways, like I said earlier, where you can manage the tenants so that you manage the tenancy and managing the process so that you continue to do well and do well for the family and then do well for the tenants and the community. So we'll talk a little bit about that as well. So tax benefits, we touched on this very briefly earlier. And I get this question a lot, not about tax, but very often, because of what I do, I would get phone calls and introductions to people who want to get started on real estate investing. And very often I hear from Bay Area people, tech people, biopharmaceutical people asking me, hey, I cannot afford to buy in the Bay Area. I'm thinking of just buying out of state. Well, so they would buy out of state as rentals. And I think when they do that, instead of buying a primary residence, they would miss out on some very attractive tax benefits. As for example, the biggest one I feel is that when you buy your home, and let's say your home appreciates, the first $250,000 of that gain is tax-free, is tax exempt. And for a married couple, that's $500,000. I think that's one of the best tax deals in the world. Well, I don't know about in the world, definitely in the US. And so if you think about compounding growth, compounding wealth, you have to take advantage of these tax benefits wherever you can. So that one with a primary residence is key. And of course, the government also offers mortgage interest deductions and property tax deductions in your property taxes. So every bit of tax savings will help you towards growing your assets so that you're growing tax-free or tax-deferred wherever you can. And then this came up, I think, at one of Jean's earlier presentations. So I want to make sure to remind everybody, not all CPAs are educated enough about real estate taxes. It still surprises me how often I hear from my own clients that their CPA told that the CPA did not tell them that they have this capital gains tax exclusion that I just mentioned, the $250,000 per couple. So when they don't know about that and they don't advise the clients about that potential tax savings, that could mean it's not that they would not save. I think eventually maybe the tax software would tell them that. But I think this is a missed opportunity if your CPA is not telling you about that. So make sure you interview your tax advisors and they know these real estate basics.
That's CGT exclusion. Are you talking about like selling our primary residence?
Right. When you sell your primary residence,
Oh,
okay, you get $500,000. As a married couple, you get $500,000 of tax-free gain. That's huge. You know, if you think about it, if you don't take advantage of that gain, it's not the end of the world. If you love your home, you love your home, don't sell, right? But if you're thinking of making a move, and you can only do it on your primary residence, then if you keep your primary residence as a rental, you're missing out on that $500,000 tax-free gain. So what would you do differently with that information? Yeah, 500, I mean, if you're taxed at 33% per year from the federal and state, that's 145,000. That's pretty significant. So for rentals, there are also a lot of tax benefits for rentals. And so, for example, in that example where John just asked about the primary residence. So if you choose not to sell your primary residence and you keep it as a rental for a couple of years, then you can, as a rental, you can actually do a 1031 exchange and use that asset, use the sales proceed to buy one or two additional properties for your portfolio. So the tax law, if I remember correctly, is that you have, if you have lived at that house as a primary residence for 2 out of the last 5 years, then you can take that $200,000 to a $250,000 tax-free gain, or $500,000 as a couple. And then if you, at that time, if you choose not to sell, but you choose to sell, let's say 6 years later, 7 years later, you have the option of deferring that gain, deferring the tax on that gain through what's called a 1031 exchange. So that's also a really, really good tax benefit a lot of people don't know about.
And just to note that we actually did a seminar on that too. So we have that on our YouTube video, but a really good technique or strategy to use.
Yeah, that seminar was really good. That CPA was really good.
Yes.
Yeah. So something else that a lot of people don't know about, especially for dual income couples, this is important. And this is a lesson that Eric and I learned. So while we were working at HP, this is 19 years ago, we were paying a lot of taxes. And we went to one of these seminars and someone said that if one of us is a real estate professional, then we can use all of the phantom losses we have from real estate investing to write off against the other person's paycheck, W-2 income. So then Eric and we did this analysis using TurboTax. At that time, we thought we knew everything and that TurboTax was enough. So we actually used TurboTax, and we were both working in tech. So our annual income was between 180 to 200,000 a year per person. And I realized that with both of us working in tech, and if I were to go off and do real estate as a real estate professional, which just means logging enough hours, then the total impact to the company, to our household was only $20,000. So recap, I was making around $180,000. And if I had quit my tech job and do real estate full time, according to TurboTax, the total loss to the company, or from all the tax savings, the total loss to the family, to Eric and me, was only going to be $20,000. So it wasn't worth it for me to continue working on a W-2 paycheck. We felt that it would be better for us to find another avenue, another stream of income, so we have a better potential for retiring with rental income. We thought we would retire with lots of cash flow and footloose and fancy, but it didn't happen as quickly as we had wanted. So why Bay Area real estate? I think, again, we talked about some of this earlier as well. And I think it's important to think of it differently. So remember I mentioned that Eric and we bought a rental house in New Mexico, and it was cash flowing really nicely. We also had a good tenant without a lot of turnover. But after I think it was about 12 years, our total gain, real estate property value gain was only $2,000. Okay. So if you are investing with a 30-year horizon or even a 20-year horizon, I think it's very important that you think about compounding appreciation and not just compounding cash flow. So for example, on that rental property I mentioned, so great, we get $2,000 a year of positive cash flow. Probably not even that, because we had to repair air conditioning or refrigerator or hot water heater. So, but even if it's $2,000 a year, compounding $2,000 a year is not a lot, and that compounding is not leveraged. Meaning, if we buy a property with a 20% down payment, right, the entire property appreciates, not just our 20% down payment. So we'll talk about a little bit about that as well. But I want people to think about compounding appreciation and not just cash flow. And then the second thing I think is important for people to understand and think about, especially when when they hear about cash flow investing. If you think about Home Depot prices are the same across the entire country. So one toilet in Texas is the same as a toilet in San Francisco. And if you have to spend the time and energy to hire a plumber to fix that toilet, there's actually, in the Bay Area, there are more plumbers, and that competition means that there is more, there's better pricing in Bay Area plumbing, and also there's better quality. So whereas if you were to go to a small town, for example, in Oklahoma, and you're trying to find the property may have great cash flow, but you have trouble finding plumbers, or the plumbers are a lot more expensive than in the Bay Area, then at the end of the day, with you living in the Bay Area, having to put up with the housing cost of the Bay Area, would you rather spend that same amount of money and time to fix a toilet in San Mateo or to fix it in Austin, Texas? So that's also something a lot of people don't talk about when they talk about cash flow investing. And then the third item, of course, is the Prop 13 property tax protection. We mentioned that as well. That in the Bay Area, the property taxes, in California, the property taxes are pretty much fixed with very small increases. Whereas if you go to, for example, Texas, the property taxes could easily be 3-4% of your property. And that seems to change without a lot of protection for the homeowners. So those are things to consider. And then at the end of the day, for us, if we're living in the Bay Area and we want to continue to live in the Bay Area, we have to think about appreciation. Texas and Arizona and Nevada, and even outside of the immediate Bay Area, there is so much land. There is no barrier to build, right? So that's why, in Texas, for example, if they want, and we actively looked into investing in Texas, but let's say a farmer owns 500 acres, they release that land for development. All of a sudden, there's 2,000 more housing units on the market. So if you lived in the town, if you own a property in that area, how would you be able to enjoy that appreciation when there's so much competition? So that's why after 17 years, Eric and I brought all of our money from all of these out-of-state investments. We brought them back to California, and we're telling our family and friends to invest in California and to invest in the Bay Area instead. Next slide, please. And Eric is going to talk about the next few slides.
So if you look at the numbers, just as you would when you decide which stock to invest in, you generally want to look at a chart that looks just like this: lower left, upper right. And then we'll go through a few charts to show that what the number shows in terms of over the long term, the increase in rent. That goes back to the point that we mentioned earlier. When you first invest in a property, rental property in the Bay Area, you may not necessarily cash flow. And then, but over time, you will see that your property tax and because of Prop 13, and which is the main component of your cost and your mortgage are generally fixed. And then, but if you can see that over time your rent would increase, and then it's actually increasing at a pretty rapid rate. And then the gray line in the middle is actually it reflects recessions. So even through recession period, it may dip a little bit, and then but you step back from the financial news headline saying that hey, rent has dropped significantly, and then landlord are giving concessions, and then if you zoom out and then ignore that noise and look at a long-term perspective, and you will see that the rents are actually rising steadily. And then we see that when we look at some of our clients' potential clients' financials, that they have properties, and then after the 2008 crash, and then the cost is more or less fixed, and the rent gradually, steadily increase, and then they're able to leverage that increase in equity to actually go and acquire more rental property, even though that their income may or may not increase significantly.
So FRED is the Federal Reserve economic data. So it's the St. Louis Federal Reserve Bank. So this information you can get online, and we were able to get all of this online. So if you're thinking of investing somewhere else, you can go online and see what additional data may be beneficial to you for the market you're interested in. We want to teach people how to find their own property, find out where they want to buy. And we actually used some information here of properties that we actually know about or we own, and show you the rate of appreciation, and show you how you can determine your own rate of appreciation for the properties that you may consider buying. So if you go to Zillow, you know that on Zillow you can see price history. And what you do is you look at the price history of a property that you want to buy now, or that that hasn't been significantly renovated, right? You want to compare apple to apple. So in these examples here, we're comparing data from 30 years ago. So 30 years ago, or 29 years ago, these were the prices for the specific homes in Union City, in Milpitas, and in San Mateo. And then right now, if you go to Zillow, you can see what their projected value is for the same homes. Now, if you happen to have the data of when they actually sold, you can do that real world data instead of Zillow estimates. But if you gather the data from 30 years ago and you look at the data, the value now, you can very quickly, using Excel, figure out what is the average annual appreciation over that 40-year time span. So you can tell that in the Bay Area for these homes, the annual appreciation is between 6 to 6.5%. Now, keep in mind, this is based on today's data. This is not based on the peak value from April 2022, for example. So the Union City house, that was actually a house that we owned. And last year, it was showing annual average appreciation of 7% over the 30-year span. Right now, it's only 6.5. But still, this is very good appreciation. And if you think about the inflation, as much as possible, you want your asset to grow at the rate of inflation, above the rate of inflation as much as possible, right? So if you're buying out of state and you don't have that appreciation, how would you be able to beat inflation to build your wealth? So this is what we wanted everyone to understand, that if your property is appreciating at 6% every year, then the property value doubles every 12 years. So that's an important rule to remember. And that's what we're looking for in real estate investing.
As we are talking about appreciation over a long period of time, so we have a couple of charts also from the St. Louis Fed, and that shows that how housing prices appreciate for California. And then again, those great lines are period of recessions. And then as you can see in general, along also the same curve, which is that is steadily rising. And then if you look at the top, it says that from 1980, Q1, the index is 100. And now the number is hovering about 900. So since 1980 to 9, and then the appreciation has been 9 times. And then based on these numbers. So we do go up and down, obviously. And but over a long period of time, there's a significant increase in home values. And then we like to point out that the increase in home values is on the value of your home. And then if your investment in your home is 20% down payment to begin with, then the return is actually much more phenomenal than the 6.5% we have shown. We like to, this is the same charts, we like to zoom in a little bit. And then this is showing the recent past. We picked this period because it goes through 2008. And then it shows the current dip. And if you recall, the next chart is essentially lower left and upper right. And then the home appreciates, but it goes through a period of adjustments. And that's when we want to address some of the question about why do we want to buy now? Does it not, I hear that the market is going to crash. And then shouldn't I hold on? That's a very common thought. The question is that from a historical point of view, if you look back, there are periods of adjustments, but they don't come very often. So the last big one was 2008. And we kind of know what happened there. The banks fails. We have a lot of subprime loan. Nowadays, we don't have it. And but because home price has gone up so fast, if you look at the upper right, it's parabolic in terms of its rise. So it's making some adjustments. So as with buying stocks or buying other investments, and then the market is giving us an adjustment. And then you can argue that this is a good time perhaps to get in, just like after 2008, when the price has adjusted so much lower. And then when you are able to buy, if you were able to buy a property then you would actually ride the subsequent appreciations.
Yeah, so we're talking about thinking in the long haul. Don't worry about the little dip. Well, we don't know if it's a little dip, but don't stress about today's cash flow, today's dip, but look at the big picture, what you want to do, because that big picture, when it does go up, it's going to be really hard to catch up, to keep up. So we get this question a lot also, and we're also thinking about this question for ourselves. So instead of us telling you what to buy, we actually want to share with you our thought process in terms of what to buy. The first thing is, I think we suggest that you think about the 30-year, 40-year appreciation horizon, because all of us, we're going to be living longer, right? So we want our asset to continue to grow for us. And earlier we showed you how to get that appreciation information from Zillow. So then you want to compare, for example, condos, townhomes, single-family homes. You want to compare Peninsula versus East Bay versus Sacramento. Think about that appreciation horizon as you choose what to buy. And then, of course, think about the demographics in the location. So I'll give you an example. We bought a property in rent-controlled Berkeley. This is near the bottom of the market, and we were actually quite worried about the Berkeley rent control, especially. But we had to buy it because there was a 1031 exchange, and what we didn't realize was that the neighborhood was changing. A lot of the younger people from San Francisco were beginning to have kids. They wanted better schools. They wanted single-family homes. So they started moving into that Berkeley area, and more, they started renovating. The rent started going up. And then gradually, even with rent control, some of our tenants moved out. And when they moved out, we were able to renovate and bring our rental rates to the market rate at the time. So it actually worked out really well for us. But unfortunately, we didn't know enough to actually buy a few more at that time. So this is why we ask people to think about the longer term horizon. Think about the demographics, what's coming, go to a local grocery store, see who all are buying, talk to the neighbors, see what's going on in that neighborhood. And then think about the long-term maintenance of the property as well. So for example, one of our clients bought a condo in downtown San Mateo. Beautiful, classic condo. They even had area that was for maids' quarters from the early 1900s. And it's a beautiful condo, but there was a lot of deferred maintenance. So every year they would do a special assessment. Well, every few years they would do a special assessment for the maintenance of the property. And that was a $50,000, $60,000 per assessment. So that became a lot of money. So think about cash flow, think about deferred maintenance, think about if you're buying a condo or a townhome, does the exterior look like it's well maintained? Do you see deferred maintenance in terms of the balconies? Think about the long-term horizon and how much you want to force the appreciation of the property by expanding the property, or think about how you want to preserve your cash flow for your next purchase. But most importantly, we're suggesting to people, if they haven't bought their first home yet, buy their home first, because again, that's the best tax deal. That's the lowest interest rate. And at the end of the day, you need to secure your family, stabilize your family first and your career before you do real estate investing. Okay, so we have three very quick scenarios we want to cover. So the three scenarios are: first, when you move up, you keep your existing home as a rental. Second, for your first home or for your second home, actually buy a duplex or a triplex and move into one of the units as a primary residence. Or third, if you already own a home, you can add an ADU to your home, or you can do a lot split of your home. So Jean, if you would go back to that scenario number 1, I just want to highlight a few things to consider. So if you decide to move up and it's financially viable for you to keep your existing home as a rental, you can potentially use your future rental income to qualify for a new mortgage. And even if you have no prior rental experience, there are ways where you can get a % of that rental income to qualify for the new loan. So keep that in mind. Don't let that be the only reason for you to not keep your existing home as a rental. And then also, I mentioned earlier that you have a 5-year horizon to decide if you're going to keep that rental as a long-term rental, or if you want to take advantage of that tax-free gain that we talked about earlier. But that's definitely an option. If you own the home already and you've refinanced it over the last 2-3 years with an incredibly low 2.5% interest rate, then you should definitely consider keeping that house, keeping that mortgage, because that's going to give you really strong cash flow or low cost basis for the cash flow and appreciation. So second scenario, please. The second scenario we talked about is buying a duplex or a triplex or even a fourplex as your first home. So the good thing about owning a triplex or a fourplex is that if, let's say, a fourplex, one tenant moves out, you're only 25% vacant. You still have rental income coming in to help you pay for the mortgage. And you still get, because it's a fourplex or anything between duplex and a fourplex, you can still get the lower interest rate, and easier underwriting for these rental properties, have that rental income. And more people are comfortable with owning duplexes to fourplexes, that there is greater speculation and greater appreciation on these duplexes and triplexes. So those are the positives of buying a duplex or a triplex or a fourplex as your first home. But keep in mind, you're going to be living next door to your tenant. And, if there's a plumbing issue, you probably want to know, right? If they're going to be flooding the entire triplex, you probably want to know and fix it right away. But if your renters next door, make sure that you take the time to decide who is that renter. And then if you're actually buying a triplex or a property with existing tenants, take the time to ask for a rent schedule to make sure that they have been paying rent on time, and ask for a tenant estoppel where the existing tenant has the opportunity to tell you, the prospective buyer, what they expect to be happening at the property. So you can actually see if this is a property that you want to buy with the tenant in place. So there are a lot of ways and then when you tour the property, you can see if the tenant is keeping the property nice, or if you see a lot of soda pop cans all over the place. So that will also help you decide if you want to buy. So on that note, if you're buying a triplex or a fourplex, for example, you need bigger down payment. So how do you do it? Well, so if you and 2 or 3 family members want to buy it together, you can buy it together, or you can find partners to do it together. And if you decide to do that, which is what we did as well when we started buying our investments, if you decide to find partners, make sure you set up your prenuptial agreement before you all sign the purchase contract. And we can, if there is enough demand, we can talk about what we want to do in a prenuptial agreement with a business partner before you buy real estate. So the third and final scenario, Jean, please. Okay, for those of you that already own a single family home or are considering buying a single family home, this is definitely something you should consider as well. Right now, because of the shortage of housing, the state of California and actually other states as well are actively encouraging this notion of ADU, where you can build a separate unit on the single family home zoned lot and keep it as a rental to generate rental income. Now, a lot of people are doing this right now to supplement their income. And some people are choosing to move into, for example, they have a 4-bedroom house and the kids have already left the nest. So many people I know are thinking of actually building a new ADU, and then they would move into the ADU. The retired couple, the older couple would move into the ADU, lock the door, and start traveling around the world, enjoying their vacation while they enjoy the rental income from the main house. So imagine your cost of entry for something like that, if you already own a home, is only $200,000 or $300,000 to build the ADU, and then you can enjoy. You have a little bit of increase of property tax and a little bit of increase of property insurance and utility cost, but otherwise you get there's not a lot of additional new cost. So your return on investment on these ADUs can be really, really strong, probably better than buying a rental property anywhere else in the country. So that would be something to consider, or potentially doing a lot split, although I would suggest holding off on the lot split until the regulations have been tested in more markets, because you don't want to be the first guinea pig to go through a jurisdiction to realize that it's the wrong property to do a lot split. And then back to the ADU, if you decide to do an ADU, make sure you check the city to see if they have any restrictions that, so for example, we've heard at one time, for example, Saratoga was going to require the ADU to be rented to very low income households. So, if you live in Saratoga and if you're going to be living on the property, is that something you want to deal with? And I have also heard that there were others, for example, City of Sunnyvale at one time required that the owner always stayed on site for the duration of the ADU. So then that means that you will be living with the tenant next door. And again, is that something you're comfortable with if you're not able to rent out both units? So these are the different considerations. And if you are interested in evaluating any of these options, talk to your favorite real estate agent, talk to your CPA, talk to Jean, and have people around you guide you through these different options. So then our final recommendation. So recap, we suggest that you buy your home first, buy your own home, enjoy the tax savings so that you're letting your asset grow compounded with all the tax savings. Secondly, always do your own due diligence. No one else is going to care about the location, about the maintenance, about the return on investments as you do. And while the professionals that you hire may have really good intentions, they may not have the education or the experience or the time that you do. So make sure you do your own due diligence. Build your own team. And so that includes your CPA, includes your property manager, includes your real estate agent, your lender, and also consider yourself as if you're too busy to deal with tenants yourself, consider making yourself the asset manager, thinking about the big picture, and then you hire a property manager to manage the tenants, to manage the plumbing issues. So you as the asset manager, you should be deciding what to buy, where to buy, when to renovate, when to increase rent. And all of those are big strategic things that will have long-term impact that your property managers are not going to be deciding or unable to decide for you. So you need to free up your time, or at least give yourself the time, so you're thinking about the big picture strategy and not worrying about toilets. Okay, and then, two more things. Maintaining strong holding power, making sure that you always have reserves. And if you don't have enough reserve to buy, or if you don't have enough to buy the first property, don't stretch so thin that you don't have enough reserves, but rather partner with someone who's like-minded, partner with someone who has the same investment time horizon, and then learn to invest with your potential partners and groom them for your long-term strategy so that you can help each other out. Julia is asking about business license.
Mm-hmm.
Yes. So Julia, you're right. It's different for every city. So for example, in the city of Berkeley, you absolutely need to apply for a business license, and there's business license tax, and then there's additional fees and taxes as landlords. In San Mateo, unless I was told by the city of San Mateo that you do not need to have a business license. So check with the city where you have the rental property.
Yeah, definitely. I would say check with your city because it's all changing now. San Mateo is even kind of enforcing some fees and things like that, and then Pacifica as well.
John is asking, when you say buy your own home first, are you recommending we pay off our mortgage first before investing? No. If you have a 2.5% mortgage, keep it,
Keep it.
for as long as you can, because you cannot get that money back. So don't pay off your existing mortgage if it's a good mortgage. Keep it and leverage.
That's a great question.
So another question, I just want to put it on the table. I hear this a lot. Hey, we need to create an LLC before we invest. No. So yes, real estate attorneys will tell you, yes, create an LLC, shield all of that. That's fine. But if you create an LLC, then you're not going to be able to get a conventional loan, right? Because the conventional lenders will only work with with individuals. So if you buy it, if you create an LLC, then you will not be able to get a conventional loan. Your umbrella insurance will not cover the property that's held in an LLC. So you have to find another way of protecting the additional assets beyond your insurance. So I would say it would be important. It's important for you to think about what are the risks for the type of property you're buying, and then determine if you need an LLC before you do it. But if you're going to be partnering with people, right? If you're buying, so for example, Eric and I, when we bought our first 36 units apartment building, we definitely had an LLC. At the peak, I think we had 20 different LLCs that we were managing. But I think we overdid it.
So Quay had a question about ADUs. So that you just need to check with each city. So not every city has an affordability requirement, but there are some that do or are thinking about it. So it's constantly changing and updating because it is a fairly new phenomena, the ADUs. So it just depends on which city you're in. Some have affordability requirements. Some have, as Elsie mentioned, owner occupancy requirements. So it all will differ, and it has been changing as well. So definitely recommend that. Contact information for Eric and Elsie. So if you have any questions, they are great at coming up with solutions as well. So being a resource, helping you to think through investments as well as financing options. There are a lot of creative ways you can do it without paying off your mortgage. Don't pay off your 2.5%, 3% mortgage. Elsie, with the prices that you were showing, you started out at 200,000, 300,000, and now we're looking at 1.5 million. Would you still go for real estate in the Bay Area?
Yes, definitely.
And
so
you have been, right?
my vision is eventually, so my vision, my Eric and my vision together, I hope, is that eventually we will sell one every 10 years or so, as we need the money for our housing. And then we don't have kids, but eventually we will pass on the properties potentially to nonprofits down the road. But definitely, we brought all this money back from other states into California because we feel that California is a better place to invest.
I think that's what's really interesting to me, is that because you're not just saying, yes, you should do it, but Elsie's been, we talk a lot, and she's been saying how they're bringing all of their investments from all over the country back home. So one thing that we didn't talk about is just the nice thing about having your investment properties as a place that you can drive to, right?
Yes.
That you can see.
Yeah.
But I think that shows a lot, the fact that they're actually bringing their investments back, with all their experience, that they're bringing it here. Jason has a question on commercial real estate. So what are your thoughts on retail commercial real estate?
Oh, so
another seminar.
We had one. We had two. Yeah, we had two. We had a Walgreens anchor strip center, so commercial real estate is really broad. Retail is in the Bay Area. I think it's okay if you are very specific that it's not going to be killed or replaced by Amazon and other distribution-based retail shops. The challenge with retail is right now it's just very volatile. The tenants are very volatile. So how do you make sure that your tenant doesn't file bankruptcy because they're not able to deal with the inflation? So I think that's something to keep in mind. I think something you may want to consider, sort of retail, but services. So hair salons, nail salons, I'm not sure about restaurants, but those they have to be local. And I hear that nail salon, hair salon, they do really well even during recession. So that, if you're really thinking about real estate, I think commercial real estate, that may be something to consider. Eric and I would not ever recommend Walgreens or CVS or any of the nationally anchored strip centers, because what they do, and we learned this the hard way. So they will sign, for example, our Walgreens, they signed a 50-year lease. After the first 20 years, they have the option to exit the lease every 5 years. So in the middle of our lease, they came to us and said, hey, Eric and Elsie, we like our location. We want to stay. We will extend our lease if you give us a capital contribution to corporate. We were like, why in the world are you asking us mom and pop landlords to give capital contribution to this big Walgreens? So at that time, they said they liked our location. We said, oh, we're not gonna worry about that. And then a few years later, Walgreens moved literally across the street. Okay, because they didn't get that concession from us. So they moved across the street, and that was at the same time that our loan was coming due. For commercial real estate, there's a balloon payment. So we don't recommend, and so people talk about Walgreens as if it's the best investment in the world. It's an investment for orphans and widows. Okay, that's how it was sold to us. And I would say, don't ever do triple net national credit tenants, because they will come back to you and ask for concessions. Jason, did that answer your question?
Hopefully it did, because he said great. So great.
Elsie, that for rental properties, for apartments, anything that's 5 units and above, it's also considered commercial. Yeah.
Right. So that requires commercial real estate loans, and the underwriting is different and the regulations are different. So that's why we're recommending, especially in the newer investors, to do the smaller, duplexes up to fourplexes at the beginning.
Just to reiterate, for people who didn't catch that, so residential is considered just 1 to 4 units. Once you get above that, it does turn into technically commercial. It's interesting to commercial, residential, commercial, or commercial residential.
Yeah, the loans are very different.
Very different.
And then the state also has regulations about tenants for anything that's 12 units or bigger.
So with that, thank you everyone for joining us today, and especially to Elsie and Eric of Abundance 99 for joining us, and wishing you all a great day. Bye.